We're going to start with looking at mergers and acquisitions, then listed equity, and then we'll move on to private equity. Just so we have a bit more context ahead of the panel. And I know that we're going to hear a lot more from the panel on these different issues, but hopefully my presentation will set some context, and then the panelists can take it further and give more practical insights from their work across the continent. So I think probably the reason that all of you are here today is because of what's been happening in Africa. There's been a huge amount of growth, and largely it seems to be driven by the stabilizing that's been happening across most African markets. Of course, Africa is made up of a large number of countries. We've got 54 by my count. But it's useful for these purposes for us to talk about the continent as a whole, because there are some broad themes that come through. And I by no means want to say that the same applies to every country, because of course every country is different, every region is a little bit different. But there are some broad themes that come through, those broad themes of growth that's becoming quite attractive to investors from around the world. And I'll just pick out a couple of numbers from here, just to set some context. If you look at the chart or the map on the right, to start off with, we look at the GDP growth that's been happening. If you think about Africa from around the turn of the century, there's been on average around a 5% growth across the continent every year since the turn of the century, which in the context of global growth is very, very high. And just to take it down to a country level, Nigeria has actually been, over that period, from the turn of the century, so from 2000 to the present, Nigeria has actually been the world's 5th fastest growing economy, which has made an enormous difference to the lives of people in that country, and has provided huge investment opportunities for the early adopters who have gone to Nigeria so far. Of course, a lot of the growth has been driven by resources, but there's a story across different countries. There's a story for those resource-driven economies, and there's a story for the non-resource-driven economies. And there's been a lot of research done into this area. And I think it was McKinsey's report which said that the average growth across the non-resource-based economies is only 1% lower than those in the resource-based economies. So it's clearly there's greater factors at play than simply the resource growth that's happened over the last decade. And then we look at FDI, and again, I bring out the example of Nigeria, because even though Nigeria is not the biggest GDP on the continent, it looks like it's attracting the most FDI. And that's happening into a lot of the extractive industries, so the oil industry, but also a lot into the consumer sector, into financial services, and various other things that we'll cover in more detail. So again, just to put Africa in context as a whole continent and compare it to some of the large economies from around the world, if we compare it to the BRICS, so Africa actually sits, as a continent, it sits in the middle of the BRICS. So it's larger than a Brazil or a Russia, but not quite at the level of an India or a China. But what's interesting is if you look at the trend of things, you look at where things are going, and these are the forecasts are from the IMF. What they see for Africa is ongoing growth, similar to that of India and China, but they see Brazil and Russia not actually being able to maintain the growth that's seen them form part of the BRICS grouping over the last decade. Again, for some context, the GDP of the whole African continent is somewhere between $2 and $3 trillion. And I say somewhere between because the measurement is often vague and subject to rebasing from time to time. And that's because of the informal nature of a lot of African economies. As economies develop and become more structured, what you see is from time to time rebasing of the GDPs, and most of the time that means an uptick in the GDP because they're actually bringing in a part of the economy that wasn't previously recorded. So the number's somewhere in between that $2 and $3 trillion, which puts it somewhere between the economies of Italy and Germany. So we've got, in Africa, there are more than 1 billion people, which makes it 14% of the world's population, whereas there's only 3% of the world's GDP in Africa. So what we think is happening is a catch-up. It's simply a catch-up of living standards. It's a catch-up of that GDP up to the population or the share of global population that Africa actually has. And clearly, with such a big gap from the 3% to the 14%, there's a long way to run in this. There's a huge catch-up to happen in Africa. So what have the corporates been doing? It's interesting to see corporate activity because corporates often move faster than institutional investors. Corporates often understand markets, their own markets extremely well, and they see the opportunities faster than some other investors. So it's interesting to look at mergers and acquisitions activity to see where are companies investing in their own sectors. And if we look at the overall picture of M&A activity in Africa, it was on a huge run. From the early 2000s, because of the stabilizing nature of Africa, things like falling inflation, the forgiveness of debt in certain countries, there was a much more stable situation, and the corporates saw the opportunity to start buying into operations and to take advantage of some of that early growth. And that really ran through all the way until the start of the financial crisis, when a lot of transactions just got put on hold. But the difference between these two lines is the number of transactions versus the value of transactions. So you can see that the value fell a lot more than the actual number of transactions. So our reading into that says that it's the large transactions that actually got put on hold. But a lot of the transactions that were happening anyway, the smaller, more routine transactions, just continued through that cycle. And you can see this when you look at where the money's come from. Europe remains Africa's biggest investor. There's a lot of the legacies of the past still exist in those close links between, for example, France and Francophone Africa, English-speaking countries such as the UK and America still exists into the English-speaking continent. But what we are seeing is the increase of investment from China and from the rest of Asia, but predominantly from China from an Asian perspective. What is interesting to note here is if you put those bottom two blocks together, which is the blue one and the green one, South Africa and Pan-Africa, you'll see that on average around half of the investment, the M&A activity in Africa actually comes from within Africa. So it's South African companies investing either within South Africa into other companies or going north of the South African border, and increasingly other African countries coming in with mergers and acquisition activity. So what's really interesting to see is the change in the size of that green block, which was starting to get big around the time of the financial crisis, got a little depressed, and is now bouncing back quite nicely. Looking at the number of transactions, my reading into this is that there's a slight data bias. We get these numbers from Capital IQ, which is part of Standard & Poor's, but the numbers do rely on reporting of transactions. So what we see is most of the transactions that are at least reported are in South Africa, but the value of transactions in the continent is actually shifting away from South Africa into other African countries. And what's quite interesting to see here, for example, is that in 2012, Egypt was still the recipient of a lot of M&A activity, despite the Arab Spring, despite the difficulties that the countries had. It is still a very large economy in the African continent, and one where people see a lot of opportunity still. Based on this, you can see that it's the large economies of South Africa, Egypt, and Nigeria who actually make up the bulk of the value of transactions, which is not surprising. This just reinforces that, and when we look at the different sectors, and you compare the value of transactions versus the number of transactions, what's clear is that the value tends to skew towards the types of sectors which really require a lot of capital. So it's the extractive industries, heavy industries, and financials, which really take a lot of capital to start up and a lot of capital to grow. And those are the industries which are really taking in a lot of the M&A activity by value. By number of transactions, it's a little more balanced, but still skewed towards those industries. The consumer sector is one which has received a huge amount of attention in Africa, and I'll touch on it again when we look at private equity and listed equity. So when investors look at an area of the world to invest in, the first thing that's often considered is listed markets. It's easy, it's often well regulated, it's very much more liquid than private equity. So it's an easy way for investors to get exposure immediately to an area of the world. So we've taken a look at what's been happening in African markets, and the story over the last year, these are returns over the last year, have been very good. In sub-Saharan Africa in particular, there have been very, very strong returns. So investors who have been exposed to those markets have got excellent returns. The two indices that we have at the bottom there are North African indices, which as you'd probably expect, have been a bit more muted over this time. But what about some more detail about the markets? What we do know is that a lot of African markets have low liquidity. It's the biggest single complaint you hear about African markets. And just to add some context to this slide, the largest market that we've included on the slide is Egypt. And we have a version of this slide as well, which includes South Africa. And if you include South Africa on here, South Africa's market has around 10 times the traded value of Egypt. So if you include South Africa on this chart, you can't see the rest of the economies on the chart, which is why we show it like this, to give more context. But it's important to bear that in mind, that although stock exchanges are developing, they are improving, there's a long way to go. There's a long way to go in terms of liquidity and in terms of number of listings in different markets. And I'm sure we're going to hear more about that on the panel a little bit later. So another thing to consider from the listed market side, and this is particularly for investors who perhaps don't know the African markets very well, is when you invest into the listed market, you don't necessarily get a good exposure or a corresponding exposure to the actual to the GDP of the country, to the GDP breakdown. So what we're showing here, just to explain this a little bit better, is a breakdown so for each country we show a breakdown of the GDP in the first column, and then a breakdown of the stock exchange in the second column. So you can see a lot of orange on this chart in the second columns, and that's actually the financial sector. So and these are the larger stock exchanges on the continent. So what you can see is that there's quite a heavy exposure towards financial services across most African markets. And that's just something to bear in mind. It's not necessarily a bad thing, because financial services sits behind a lot of other industries. So in order to facilitate the growth of other sectors, you need a strong financial services sector. You need banks to be capitalized. You need insurance companies to be capitalized. So that's not necessarily a bad thing. It's just something that you need to bear in mind, that if you invest into an African stock exchange, you're likely going to get a large exposure towards financial services. If you combine these markets, it kind of simplifies the picture, but you do get more of a wider exposure and slightly less of an exposure to financial services than you would get just investing in a single exchange. But there's still that quite heavy exchange or heavy bias towards financial services. What this chart shows is the valuation of African stock exchanges, because the question is often posed, well, how expensive is Africa? Has there been so much hype now that the price of markets have actually been pushed way up and the opportunity's gone? And I think this answers it quite well. So what we show here is developed markets, they're the brown line, African markets, which is the blue line, and the BRICS, which is the green line. And on the axis here, we're showing a multiple of earnings. So we're showing a relative price of markets. And we can see here that Africa is still, on a combined basis, Africa is still the cheapest. It's still cheaper than developed markets, which is perhaps what you would expect, but it is actually what you would expect. It's not that African markets have actually outrun the developed markets, because you would expect that balance of growth and risk to be built into the price of shares on the listed markets. So given the limitations of listed markets, many investors are looking at listed markets, but also looking at alternatives, so looking at private equity. And so we've done some analysis here to look at private equity to see what it really offers on the continent. We spoke a lot about GDP in the beginning of the presentation, and what this chart is supposed to show is that looking at GDP is it's too simplistic. And in a lot of African economies, there can be a lack of diversification in some areas. So, for example, in Nigeria, although it's got a very large GDP, a lot of that GDP is actually bound up inside the multinational oil companies, for example. So you can almost take that part out of the GDP for the purpose of private equity investment. Whereas a place like Morocco has actually a large number of large companies that are potential investments for private equity firms relative to the size of its GDP. And I know that this chart can be a little confusing, so I'm happy to speak to anyone afterwards who has more questions on it. But it's really just there to try to make a bit more sense of GDP and go past GDP onto what are the real opportunities for private equity. I mentioned in the beginning that we became interested in this area because of the work that we're doing, and we do a lot of work in the private equity region or the private equity sector in Africa. And that's mainly valuation and diligence work. And so what we found was that we were developing a database full of private equity transactions. And we thought, well, this is probably quite a rare thing in Africa. There's not many people who actually have a database of a few hundred transactions in private equity over time. So we started to analyze this and actually put it together. And the next few slides are actually the results of that database, the analysis on that database. So what our data showed is that most African private equity deals are still happening in South Africa. And the period that we're looking at here is from 2006 to 2011. So we think that's shifting over time away from South Africa. But over that time period, most of the transactions still happened in South Africa. I think we're moving probably towards a half-half at the moment, where half happen in South Africa and half around the rest of the continent. But as time goes by, I think that's going to accelerate. And just looking at the growth of the private equity industry in West Africa, for example, so much more is happening in West Africa in private equity that that balance will become much more diversified over time. Outside of South Africa, the balance is between there's a fairly well-established private equity industry throughout North Africa. Some of the Moroccan, Tunisian, Egyptian funds have got onto their second, third round of funds. Whereas in West Africa and East Africa, typically the industry is a little bit younger. But there are, in West Africa, there are a couple of funds who have made it to that similar stage, or fund managers who have made it to that similar stage. When we look at the sectors, what's quite clear and what's quite interesting is that over this period, a lot of the private equity activity was focused on the consumer and the industrial space, which is quite a contrast from what you see in the listed area where we spoke so much about financial services. And that's not to say that private equity has not been interested in financial services on the continent. They certainly have. But it seemed that over this period, there were less opportunities for private equity, and perhaps those listed financial services businesses took private equity investment earlier in their life stage, and then it got on to becoming listed companies after that. So over this period, from 2006 to 2011, we didn't see much activity from private equity in the financial services area. It was much more focused on the consumer. A couple of smaller trends that we've seen come up. There seemed to be a trend towards more deals coming up in the healthcare space, education space, which very much goes along with the theory of the developing African consumer wanting higher standards of healthcare, higher standards of education as incomes rise across a lot of countries. So this is a similar chart to what I showed you on the listed side, and you can see it's more balanced. Certainly there are some financial services investments, but the sector breakdown is a lot more balanced towards GDP. This is not an advert for private equity, by the way. It's just this is how it actually has been over the last number of years. So I showed you I showed you pricing on the listed markets, and this is our analysis of pricing or valuations in the private equity markets. And I just want to spend a minute here just to explain what you're seeing in this chart. The bars here are the deal multiples. So those same type of multiples I showed you in an earlier chart. This is the enterprise value to EBITDA, an earnings multiple. So the blue block is the debt component, and the green one is the equity component. So you can see that leading up to the financial crisis, there was a fair amount of debt used in private equity deals. So the blue blocks were a larger component of the whole. But post the financial crisis, that level of debt in private equity deals has actually dropped off quite substantially and hasn't really recovered to the levels that we saw leading up to the financial crisis, which has been quite an interesting thing to see. That's in contrast to the US, which is the blue line over here. That's the overall multiples, and this blue dotted line is the US debt multiples. And so you can see US debt multiples, they fell off after the financial crisis, but they've started to pick up again, and they're actually at quite high levels. They're approaching the levels where they were just ahead of the financial crisis, which is perhaps something to keep an eye on. From a global perspective, or from an Asian perspective rather, which is the only other comparative data we have, because this data is quite difficult to come by from around the world. African multiples are clearly lower than across, in general, than other parts of the world. In 2010, for some reason, we saw a lot of optimism. We saw an uptick in the multiples in Africa compared to other parts of the world. The next bit of analysis we did was to break down this pool of deals to see, well, what does it mean by size? Are there very high multiples being paid in certain deal sizes? And so we broke it into pools based on enterprise value. So at the smaller end of the scale, those are enterprise values up to $25 million. We saw an average of just over 5 times multiple, whereas the global average is 6. And that trend actually continued across all the different sizes, with on average African deals being around 12% cheaper than deals globally, which was very interesting to see come through. I didn't expect such a consistent picture across the board. And just to conclude, this kind of puts the picture together from a listed and an unlisted point of view. When we looked at Southern Africa, West Africa, North Africa, East Africa, we compared their listed market pricing compared to the unlisted market pricing. Because we wanted to see, is there a discount that's actually happening because of illiquidity in private equity markets? Given the lack of liquidity that we know is actually on the listed markets, is there still a discount? And it turns out there is. There's a fairly large discount that's still in place. We think the East African data is a little bit of an anomaly. It was the weakest area of our research. We had the fewest transactions in this area. So I'm looking forward to see what happens in the next round of our research, on which we'll release second quarter next year. And I expect to see probably a similar story in East Africa to what we're seeing across the other regions, in that private equity is a little bit cheaper than listed equity because of that liquidity discount that's in place. So to conclude, I think what's very clear is that there's a huge amount of interest now in Africa. There's been research being done around the world. This report that we put together has been downloaded by people in more than 70 countries around the world. There's a huge interest in Africa, which probably wasn't there even 5 years ago. There's been research that's being done across the US, across Europe, and within Africa, and people like AVCA and EY have also done pieces of research that all add to the story about what's actually happening in this continent, which most people around the world don't know much about. And I hope that from the research that we've done here and the research that we're going to hear about later, it'll give you some more of a more tangible feeling for the actual nuts and bolts of what's happening in Africa and give you more context to the African continent. Thank you very much.